The U.S. Federal Reserve has kept interest rates on hold while also projecting higher inflation. But the central bank did indicate that it still sees 2 more rate cuts this year. Joining us now for more is Sam Chai of TD Asset Management. And Sam, as I mentioned, the Fed held rates steady as widely expected. Anything stand out for you today?
So, as you mentioned, this is quite a widely expected decision. The Fed has held the rates unchanged, largely in light of the still very resilient hard data we've been seeing, and also upside inflation risk, particularly from the trade policies. But coming to the meeting, the market had been a bit more focused on dot plots and any changes to economic projections. So let's dive a bit into that. On the dot plot front, the Fed continued to forecast a 2 cuts baseline this year, so unchanged versus March. This is a bit of a dovish surprise because the market has been a bit torn whether we get 1 or 2 dot cuts this year. But for 2026, the Fed projects a 1 cut baseline now, so down from 2 back in March. So that is a bit more of a hawkish surprise. So you see, we get some dovishness and then some hawkishness in the dot forecast that way. And when looking at the economic projections, expectation is that the revision will move towards a more stagflationary flavor, and that had been what we got, actually. So the Fed had revised upwards the inflation forecast and revised lower the GDP potential and the growth over for this year and next year. So indeed, the Fed does see more of a stagflationary outlook for the economy. So overall, while we got some more new information from the Fed on their outlook, I don't think there's a lot of major surprises from what we're seeing here. The Fed has also, I think, succeeded in retaining a lot of optionality. By still signaling 2 cut baseline this year, the Fed is implying that the coming meetings can still be live and they can assess incoming data to potentially move nimbly as needed.
Okay, I want to go back to consumer price inflation, because you mentioned that they've sort of upgraded their outlook there. But U.S. inflation has surprised to the downside in recent months, and the job market is holding steady. What do you attribute this to, and are President Trump's call for a rate cut warranted?
Yeah, I think it can be interesting to look at this question from a company level perspective. So in general, I think many companies have prepared the tariff impact well. Many companies were able to essentially delay in passing these price increases to consumers and basically absorb the margin impact on their own balance sheet in light of still high uncertainty as to how the tariff policy will evolve in the coming weeks. That being said, if you look at some of the corporate survey data, it does show that many firms are expecting to eventually pass these price increase through to consumers. So that does pose an upside risk to inflation going forward. And also, if you look at the market implied pricing of how CPI headline inflation year over year will be in the later half of this year, it does show that market expectations that will again exceed 3%. So if that is to materialize, that will be a meaningfully hawkish factor for the Fed as well. So overall, I think in light of resilient hard data and upside inflation risk we just talked about, I think there's reasonable ground for the Fed to be patient here, rather than delivering the 250 beeps cut that President Trump is suggesting right now.
Okay, let's talk about the bond market, because long-term U.S. Treasury yields still remain elevated because of fiscal concerns, including the president's proposed tax bill. What does this mean for the Fed's path going forward?
So, of course, the bill proposed had been a major debt sustainability concerns. And just to quantify this a bit more, the bill the version of the bill that's passed in the House essentially will result in a $3 trillion increase in deficit over the next 10 years. So, for example, that would imply that the fiscal deficit as a percent of GDP in the U.S. will increase from 6% this year to around 7% next year. So a very high number, considering where the economic cycle is right now. And so obviously that had led to an increase in Treasury term premia, and expansionary fiscal policy itself is also reflationary. And it is reasonable to expect that the Fed will incorporate that into their baseline forecast and policy path expectation going forward. However, I think a more full incorporation of the fiscal impact will likely be reflected in the September meeting, when we have a much clearer view of what will actually be passed in that bill, instead of having those fully reflected in the economic projection we just see the Fed release.
Okay, now one of the things that had sort of hit the headlines this year is the strength of the US dollar. And despite some short-term gains we have seen in the US dollar, it continues to come under pressure this year. Where do you see the currency going from here?
So we talk about the concern on the US fiscal outlook front. Of course, there's also very high policy uncertainty on the US front as well. These factors are posing a threat to the long-term credibility and stability of the US dollar. On the other hand, we have tailwinds for other major currencies. For example, the expected policy divergence between Bank of Japan and the Federal Reserve had been a tailwind for Japanese yen this year. Another example is the Germany fiscal reform had been a supportive factor for long-term growth potential in Europe and has been supportive of euro. So all these macro factors are arguing for a medium-term depreciation of the dollar versus other currencies. That being said, I think in the very near term, there is, in my opinion, interesting risk-reward for a rebound in dollar strength in light of how much repricing the dollar had already done. So I think the answer to this question is more of a matter of the time frame we're talking about.
Okay, so given what's happened today, what are the indicators that you'll be watching closely over the next few weeks and months that could swing the Fed one way or another on rates?
That will be labor market indicators. Of course, non-farm payroll will be very critical to watch, but also more leading indicators, including jobless claims or soft data, including PMI employment surveys, will be very important to watch and gauge how labor market is evolving. And the reason I emphasize these indicators is because I think that the bar to a bad news cut, meaning that labor market deteriorates and then Fed deliver cut, is that much lower than the bar for a good news cut, meaning that the Fed cut because of benign inflation. Especially if we're talking about a scenario where the Fed delivers 2 or more cuts this year, I think that is quite a bit more likely the case that is due to labor market deterioration versus we're just getting some benign inflation data.